The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the first presentation of Digging into the BI for 2024. It's January 8th, and we have 4 new stock presentations to be able to show you. We're going to be doing Gentex, we're going to do East West Bank Corporation, we're going to do NAPCO, and then we're going to do Ares Capital Corporation. So this is a program that's sponsored by both the Maryland and the DC chapter, and we're glad you're here. You do not have to be a member of either of the 2 chapters. You can be anywhere. You don't even have to be a member of Better Investing. We're just here to be able to show you what you can get out of a BI membership. Let's go to our next slide, please. So this is our standard disclaimer that we're doing these presentations for educational purposes. We believe, like Better Investing, that all investors should conduct their own review and analysis of any companies. Any securities that we discuss here may be in our personal portfolio or in our club portfolios. We will try to alert you to that, but just be aware of that. And again, if we show you any websites or we mention any sites other than Better Investing, we are not promoting or saying that you need to use those to be able to make your own investment decisions. We will record this. You'll see the blue underline there. That's where you can be able to actually see the recording over on YouTube. And we'll show you how to do that in just a slide or two. So let's go to our next slide. So for those people that don't know who we are, we're part of Better Investing. It's a not-for-profit education organization out of suburban Detroit. It's been around since the early 50s. And again, we focus on long-term fundamental investing. And again, anytime you see these blue hyperlinks in there, if you get the PDFs and they're there in the handouts for you, it will take you straight to that location. So if you want to know anything more about Better Investing, or if you're in Better Investing and you want to show this to someone who's a prospective member or someone who wants to just become a part of your club, please do this and share it with them. Next slide, please. So here's where we are up on YouTube. It's very easy. It's Digging Into BI at Digging Into BI up at YouTube. And this is all these recordings, like I said, will be up there. They're free. We only ask that you like, share, and subscribe this so that we can be able to build it. This is the way the algorithms work. We want to be able to get as much traffic as possible with this. And then also things are organized in what YouTube calls chapters. And what that is that there's little breaks at the bottom of each one. So that way you don't have to listen to the entire presentation. You can just go to the stock presentation you want to look at. Next slide. So here's again, if we need to be able to troubleshoot or find things, most of you seem to be pretty good at this. But the biggest thing is that to be able to get the handouts. And if you look where that green arrow is there, that's where you can be able to get the handouts. You're going to have the completed slide deck and 4 completed stock selection guides. That's the way we analyze a stock in Better Investing. So get those before the event shuts down, so that way you can be able to look at it at a later time. Next slide. So why are we doing this? Well, we sort of like to be able to show our members in the Better Investing community the resources that you get through your Better Investing magazine. And so if you're not a member, again, there's a hyperlink for a free 90-day trial with that. But we focus on showing people that are beginners or uncertain of their judgments how we go through a stock selection, how we make our decisions. It's a way for all of us to be able to do best practices. And again, we're all from the Mid-Atlantic or formerly from the Mid-Atlantic. So Maryland, DC, or Virginia, and we want to be able to promote our model clubs and promote we used to call it a Visit a Club program, and now we call it Club Connect. But again, you don't have to be from Maryland, DC, or Virginia to be a part of this. Next slide, please. So in just over an hour, we're going to show you 4 stock presentations by using the stock selection guide. 2 will come from the member-only magazine, the Stock to Study and Undervalued feature, and the others will be able to come from something in the BI website. We may have found it other places, but we try to be able to show you all the resources that are available. It can be from First Cut. It can be from using the screening tools or the ticker heat map. In the case of my presentation, it's something that I actually own in my portfolio, but it also shows up in a custom screen. So let's go to our next slide and we can talk more about it. So here again, you don't have to be a BI member, but if you go to Home About Us when you sign into betterinvesting.org, and at the top of every one of these slides, is the URL to be able to go to Better Investing. So these stocks were announced to the larger audience at the end of November, the stock to study an undervalued future for here. They already put out the ones for February. And so you can find these right away. So if you're in a club and you want to sort of be prepared for whatever's coming up, you can look here and you can find it. You don't have to wait for it to be able to come in your mailbox to find out what the stock to study is. Next slide, please. So we also have future announcements. If you're a member, you can be able to get this. You get it by, if you see where the red circle is up on top of the banner where it says My Account, that if you click on that, that's where you'll get to the My Account page. And then from there, it opens up to where the My Account stuff is over on the left-hand side. And you'll see the green circle, which is email, product, and subscription information. If you click on that, that opens up into that green box over on the far right. So 3 steps to get to there. And if you want to get your local news, what you want to do is you can click where that sort of darkened blackish dark blue arrow is, and that will give you your local news for whatever chapter you're in. But before you're going to have to hit Save Changes. But before you do that, I suggest you sign up for the weekly newsletter, which is that yellow highlight that Cheryl's showing you to. And if we go to our next slide, we'll show you what it looks like. So this is what it looks like. This is, again, just for members. It highlights what's going on in our larger community. It comes out at the close of business on Thursday. And if you signed up for it and you're not getting it, you better check your spam filter. And here's some of the things that are coming on up. They have, different stock ups and ticker talks to be able to help you through. There's some stock ideas, what's coming up nationally. So go ahead and sign up for it, and everything is set with a hyperlink so you can look at it straight from your email page. Or that's how I look at it. Next slide. So we're also up on Facebook. We've mostly been putting stuff up at that Facebook page. It's MICDR REG. That's the Maryland, that's the DC regional chapter. So you don't have to be a member. You can be able to see what's going on there, and you can share that with people outside of our community that may want to know more about long-term fundamental investing. Next slide, please. And Cheryl, tell us about what's coming up.
So we have Money Matters, which is coming up, not this coming Tuesday, but the Tuesday after. And we're going to look at an oldie but a goodie, Benjamin Graham. I'm sorry.
Peter Lynch.
Peter Lynch, thank you. And his investment book, which was put out quite a while ago, but things in there are still relevant. So we are putting that up in January. And again, that's coming on the 16th of this month from 7:30 to 9 p.m.
Okay. And this is my club and also Cheryl's club. This is Happy Destiny Investment Club. We're technically in the Maryland chapter because I live in Baltimore, and that's where the club is located. We meet on the 3rd Friday of every month at 6:30. It's online. You're welcome to come visit us. You can be able to reach us out through that point of contact at digging into BI at Gmail. I couldn't find what our education and stock studies were. Do you remember what they are, Cheryl?
Education, all we had on the planning meeting notes was that it was between one of our newer members, but we didn't have anything in there in that or in the education block. All right. So that's something we're going to have to decide, I guess, on Friday.
Very, very good. Anyway, we will have education. We will have a stock study. So let's go to our next slide. And Florencia, if you can unmute yourself and tell us about your club.
It won't let me unmute her. There we go.
Kevin, can you hear me?
Yes, we can.
I can hear you. Go ahead.
Okay. I am not able to see my screen, so please someone present while I try and figure this out.
All right. This is the model club that's out in Montgomery County, Maryland, MCMC. It was started in 2017, currently has 5 partners. They've had more than that, but people have left the club for whatever reasons. And now on January 17th, which is the 3rd Wednesday of each month, they're going to have their meeting from 7 to 9, and they are online. And there is the link, the hyperlink to get to that meeting. And both the education and the stock to study are both to be announced.
Okay, let's keep moving.
All righty.
And I think it's Gladys's club. You want to tell us about your club, Gladys?
Yes, I thought Cheryl was, but that's fine. Good evening. We started in 2008, and we now have 13 partners. We meet tomorrow night, the second Tuesday of the month from 7 to 9 online. Here's the link. The education for our upcoming meeting is selecting a high and low PE for the SSG, and our stock study is Excel Service Holdings, EXLS.
Very good. Thank you. Cheryl, tell us about this Club Connect program.
Back to me. All right, this is a new program for BI, and it replaces, as Kevin said, that Visit a Club. And it supposedly is an easier way for clubs to find like-minded members interested in joining an investment club, as well as helping individual investing members to connect with local clubs that might either hold live meetings and be in their area, or maybe not so local that meet virtually. So Connect offers the individual investors matching factors like gender, distance, and other preferences in a confidential listing so that they might find a club that matches their needs.
And since this is digging into the BI, we like to be able to at least sort of look at, show you where, the magazine, you can get it on the left side in an app. You can also get it in the e-magazine. It can come out as early as early December. Sometimes they're 2 or 3 weeks in advance. So you can look at it on your computer, laptop, or smartphone if you so incline. I've asked periodically over time if people use any of these 2 forms, and most people say, no, they just wait for the magazine. So maybe we'll have some new people that want to try this. Let's go to our next slide, and we'll show you how to sign up for this. So what you do is you come on over here into Learning Center under BI Magazine. And if you see where I have the green arrow on the left-hand side, it says Better Investing Magazine for Mobile Devices. It's a separate sign-in than what you have for the BI site, and it'll walk you through the steps that go there. So that way you can be able to take a look at these things when they come on up. The other red arrow, let's back up there. The red arrow is for the analyst reports and other resources. So when you ever see these magazines that have the stock to study or undervalued feature and they say there's additional information, this is where you will find it. So you can click on that and you'll get the additional information that they used for the research. Now let's go to the next slide. And so the January issue is combined with February. We do this, so there's 10 issues a year, so this happens twice a year that we do this. And the article that caught my attention was one that was written by Ken Jenke back in I think it was in the 80s. And again, the point that he was talking about, George Nicholson, the person who got us all started here in Better Investing, said the way to really measure your investment success is by the performance of the whole portfolio, not in individual stocks. One of our regular presenters here, Jonathan Hunn, has always been a very strong advocate of that as well. So if you want to take a look at it, go examine this article and see what's going on. Let's go to our next slide. And there's several things that are coming on up. All of them are online. Some of them, like the Rocky Mountain chapter, is having their own 2 Saturday series on the intro to investing, and then the next week they do their stock study, or their way of showing you how to complete the SSG. North Florida is having some stuff coming up in February. South Florida is having things too. So I always take a look at this page 51 in the magazine so you can see all the different events that are coming on. And because of modern technology, you don't even have to be in those chapters, just like here, to be able to see the events. Next slide, please. Well, now we're ready to be able to get on in and talk about the stocks that have been featured. And we're going to first go to Kent and tell us about the stock to study in Gentex.
Okay. Next slide. There we are. Good evening, everyone. I'm glad to be with y'all. I'm coming in from the Alabama Emerald Coast chapter. And this evening, I'm going to take a quick look at Gentex Corporation. Better Investing Magazine's January stock to study. You'd also have seen it on the ticker heat map as well as the BI Top 200. Next slide, please. I had a chance to do a quick scan of the article about Gentex online, and it's got some good historical information as well as some good analysis. I'll let you all read that. Next slide, please. So founded in 1974, Gentex develops, manufactures, and markets proprietary electro-optical products. The company is recognized worldwide for the manufacture of electrochromic auto-dimming mirrors for the auto industry. Sorry about that. And they sell to every automotive manufacturer worldwide, or nearly every automotive manufacturer. And prior to the mirrors, Gentex started its study of electro-optics by creating fire protection. So next slide, please. About 10% of the company's revenues come from the fire protection products group, which is their very first group. And as I mentioned, it's where Gentex gained its capabilities in the photoelectric sensing devices and the electronic circuitry. Next slide, please. Currently, Gentex's aerospace area is a very tiny portion of the revenues. And even though this is a small part of the current revenues, it's been working with Boeing to install these Gentex electrochromatic windows in the Boeing 777ER as well as the Boeing 787. And you might have seen it if you've been on a 787 or a 777ER. Next slide, please. And the aircraft electrochromatic windows are descendants of the company's auto-dimming mirrors, which descended from the fire protection products, as I mentioned. So the Gentex Automotive Product Group shipped 44.2 million interior and exterior auto-dimming mirrors for nearly every automobile manufacturer worldwide. And those shipments accounted for 90% of the company's revenues. Those mirrors have spawned a whole host of auto-dimming glass from exterior mirrors to side windows to sunroofs. Next slide, please. One of the challenges that I see that Gentex has is it seems to be really focused on the dimming glass. And I'm a little concerned about disruptive technology such as cameras eliminating the need for those Gentex mirrors. The company's been working on integrating several new technologies into its offerings, and the full display mirror is one of those offerings. It essentially melds mirrors, cameras, and sensors to help a driver to see what's going on outside the car as well as inside the car. And the mirror acts as a good backup in case the cameras fail. And again, this is a small portion of the company's revenues, but it does seem to be growing. Next slide, please. Just to give you a picture of what's going on with the revenues as of September 2023, you can see that automotive mirrors are basically now up to 91% of their revenues, but their new technology, the HomeLink modules, little garage door opener closing, setting alarm systems, that kind of thing, that is becoming an increasing part, still a small part at 7%, but an increasing part. And then again, their fire protection products have shrunk substantially down to about 2% as of September 2023. Let's go on to the next slide. So let's take a look at the stock selection guide now, and this is the sales. And while Gentex is the highest growth rate in the sales in its peer group, it still is meandering along at a mere 4.2% over the last 10 years. The pandemic, even though Gentex suffered much less than its peers, still suffered. Prior to the pandemic, Gentex was growing at an annual rate of about 7%. Post 2020, Gentex sales have recovered to about 6.6%. Next slide, and here's the numbers for that. As you see, the 4.2%. Next slide, please. Again, Gentex has the highest earnings per share growth rate in its peer group, yet its growth has been a slight 6.6% over the last 10 years. Now, the pandemic, even though Gentex suffered, the Gentex earnings have been pretty stable, even though they had a little bit of a meltdown in 2021, 2022 throughout that meltdown. So prior to the pandemic, if you look carefully, you'll see prior to the pandemic, things were fairly flat, but you'll do see a decrease in 2022. And so I was kind of curious about what that was, because it really did show a substantial decrease in the numbers. And primarily that was that their cost of goods, research and development, and total operating expenses increased by more than their revenues increased. And so that caused the drop in earnings. And then I looked at the reason why that was, and it was because they really scaled back substantially in 2021 on their spending, and then 2022 they scaled back even more. In 2020 they scaled back, 2021 they scaled back even more, and then 2022 they increased that spending to make up for some of the savings that they were creating in 2020, 2021. So next slide, please. If you check out, next slide. I used to give you the numbers there. Moving on to there you go. Go ahead over to slide 34, I think is what we want. There you go. So check out the price over the last 10 years, and you can see with the purple bars and the burgundy bars that the price has been climbing at a slow and steady rate. Since 1981, the stock price has split 32-1. Next slide, please. All right, so one of the things we also wanted to know is how the Gentex managers are working out. You will note that the pre-tax profit on sale, or the profit margin, and the return on equity are the highest in the peer group and the industry. Now, while the profit margin has declined over the past 5 years, there seems to be a rebound starting in 2023. We'll see if it continues. The debt and debt to equity at 0 is substantially below Gentex's peers and industry average. They have a huge amount of cash that they can really focus on growing the company, as well as providing some money back to their shareholders. And if you remember, we were talking about some of the changes in 2021 and 22. Those expenses compared to the change in 2023, you can tell that they're kind of shifting, and you'll see those changes reflected here. Next slide, please.
5 minutes.
Thank you. Forecasting their sales and earnings has been kind of a bit of a challenge. Over the last several years, Gentex was kind of depressing to look at. However, this past year, things are looking way better, and the managers have been working on returning their company to a happier and better growth trajectory, at least for me. Having said that, I am going to predict that there are 9% sales growth for the next 5 years. Next slide, please. Earnings growth was a bit tricky. During COVID, the earnings per share kind of grew at a negative 5.2%, which did not lead to a lot of confidence in the company. But as I suggested earlier, most of that negative growth occurred in 2022 when they were rebuilding after the pandemic effects. Compared to 2020, compared to 2019, Gentex still has a way to go to rebuild its earnings, but they are making progress. And I did a little cheat with the preferred procedure and actually did that on a spreadsheet, and that gave me with a revenue growth of 9%, that resulted in an earnings per share growth of 12%. So I am going to be forecasting their earnings per share growth at 11%. Next slide, please. Oh, by the way, that earnings per share growth rate is less than what Value Line is indicating, which they're indicating about 12.6%. So it's nice to have a company with a well-behaved price to earnings history. I have no outliers there, so you'll see that the estimated high price is $63.40. Next slide, please. The low PE is just as well behaved, and so with that, we're estimating our low price to be $25.30. And if I looked at the 52-week and the 104-week price history, this seems to be a pretty reasonable low price. Next slide, please. We can see, given the price as of Friday, that falls into the lower hold zone, lower part of the hold zone. Close to the buy price. Given some appropriate wiggle in the price, this probably could be purchased with some potential to earn money. But should we buy Gentex? Next slide, please. Gentex does have some vision for growth in their vision systems. You'll see the auto dimming mirrors moving into camera monitoring systems and rear display cameras. Next slide, please. As I mentioned, they are doing some 787, 777 aerospace windows. They're looking with Boeing to make those a little bit bigger in their markets. They're also been putting in dimming sunroofs in some cars like Audi and some other cars as well. So you might see that happening in your neighborhood. Next slide, please. And then the connected systems, I mentioned HomeLink, but what I found very interesting was this digital video recording that they've started putting on some Toyotas. And that is if you have like an accident, like somebody whacks you from behind, then automatically you'll have a camera that's been recording what's going on. Or if you've got a bicyclist there that weaves out in front of you, you might see that as well on the camera. Next slide, please.
1 minute.
Even so, there is some, thank you, Brian, even though there is some reason for caution, I'm concerned there may be some competitors coming out of the woodwork with some new technology that'll push aside that dimmable glass technology. But Gentex does have a narrow moat. Next slide, please. So Gentex is a smallish, medium-sized company, so they're about $3 billion in revenue. It's a moderate growth company, so it's not growing as fast as we would expect some of the smaller companies like that, but it is very well managed. As of Friday, Gentex was overvalued, trading above the 5-year PE, but it is a buy up to $30.20 for a 15% return. And I think it's a worthy candidate to put on your watch list and maybe snap up some shares if the price drops to that $30.20. Next slide, please.
Thank you very much. And while you're in Alabama, we still view you as a Marylander since you started here.
Why, thank you very much. Thank you very much.
Anyway, so I'm going to be able to talk to you tonight about East West Bank Corporation. I'm in both the Montgomery County Model Investment Club and then also in Happy Destiny. So I found this basically by doing a custom screen, but I also want to let you know what's in my personal portfolio. So let's go to the next slide and let's go through some of this. So this is probably one of my best examples or quotes or understanding of why you need to have bank stocks in your portfolio. This comes from a Morningstar book that's 13 years old now, 5 Rules for Successful Stock Investing. And it says, again, I won't read you everything, but banks, you need them for the capital formation. So, you can't, most people cannot buy a house without getting a loan. Same with businesses trying to expand. So banks are at a critical point in sort of being able to get things going in our economy. So when they start to go, so they have a little bit of a cyclical nature to them. So in other words, when things change or they go down or people are slowing down, they're not going to be able to give out as many loans. When things are going better, they're going to have a lot more business. And so keep that in mind. And let's go to our next slide. And this comes from Fidelity, and you don't even have to be have an account there to see it. But one of the things that they show up here is they sort of show you the sort of rotation. If you see that sort of that red box there in the middle of it, that sort of shows you where we should be and what sectors we should be in based on where we are in the cycle. So when you're early in the rebounds, the ones that are there, financials, real estate, consumer discretionary, information technology, industrials, and materials are there. Then as we start to get to the top of the market, some of them you move away. That approach is called sector rotation. Now, that's not necessarily what we do here in Better Investing because we tend to be long-term. However, what I like to do is I like to be able to look at sectors that are going to start to do well in the future, and I want to sort of get ahead of the curve. So that's sort of where I use this to say, okay, here's some sectors to take a look at. And I use it really as a shopping list. Let's go to our next slide. So here's what I did is I created a custom screen and I said, I want to sort of look in the financial services sector. So what I did is you can see all the parameters I used in the center on that screen capture, but I was looking for moderate growth because banks aren't necessarily super big growing companies. I wanted small and medium in the financial services. I wanted them to have the good management that we're looking for and a financial health grade of C or better. That's slightly above average. And then I also wanted to get ones where the current valuation, they were undervalued. So they're sort of beaten down a little bit. And that turned out to be 68 stocks. So let's go to the next slide. And one of the things to keep in mind is that what we're just discussing here is that when you're a value investor is that you really have to be patient. It's not the same as momentum investing, which is very similar to sector rotation. It's not the same as a timeliness rank, which is only going to give you basically a 6 to 12 month look on things. It's not going to be Investor Business Daily has a momentum thing. We're really sort of, again, we're looking for value. We're looking to be a contrarian when everyone else goes it. And it's best summed up by what Warren Buffett says there, which is you want to be fearful when others are greedy and be greedy when others are fearful. So a lot of people are saying, be careful of the banks, blah, blah, blah. I'm saying this is a good time for me as a long-term investor to go shopping in this area, particularly if they're good quality companies. Let's go to our next slide. So what I did is there were several of them, and what I zeroed in on was I found a stock that I already own. And so I said, okay, well, let me do another look at it. I bought it in 2019. I've actually doubled my price, doubled my value in just that short amount of time. But this company, they're out of Pasadena, California, in the S&P mid cap. And what they really are is that they're a full service commercial bank that focuses on like the Asian American community. You can see a lot of these metrics over on the other side with the financial health grade or the S&P quality. Everything seems to indicate that this is a really good, solid company. I'll do the rest of the analysis myself, but basically I sort of like to see where it fits in and what's going on. So here's a company, again, that I own that's showing up as maybe being beaten down, and this may be a chance for me to be able to put some more money into it. Next slide. So one of the things that really strikes me, and I've looked at several stock presentations over the years, and generally you see the website and you see their board of directors, and they all look the same. I'm sorry, they all look like white men and stuff like this. This is one of the most racially diverse board of directors I've seen in all the stocks that I've looked at, which makes sense because they focus on the Asian American community, banking community. But you see, not everyone there is Asian American. It's a very diverse group of folks, and they talk about diversity throughout their entire presentation. And that's a really good indication that they're matching, their words with their actions. So I like that. It's not an indication that it's like the be all and end all, but it basically confirms sort of what a general hunch is. So that's sort of how I use it. Next slide. So here's some of the things to keep in mind. It's a medium-sized company, and sometimes people end up comparing it to like Axios Financial or Western Alliance Bank Corp or some of the other ones that are really pretty popular in our community. What's different about East West is because they're a full-service commercial bank, they do a lot of loans that aren't just in residential. You'll see stuff like Western Alliance and like I said, Axios. They're basically residential or commercial. So that if they're residential, they're going to really go up and down with the market. And here they have a well-balanced approach to things. You can see how they're in both commercial, real estate, residential, and industrial. And it really sort of protects them. It doesn't make them sexy or exciting, but it does give them a really wide range of stuff going on. Next slide. So here's again sort of the commercial loan portfolio, and they do this for all of them. So this is just the commercial real estate and the commercial industrial. And again, you can see how they really are, they're not dominated by any one particular setup. You know, Kent was talking about how so much of Gentex is in one product and they're branching out into other things. Here's a company that's the exact opposite. It's very diverse, has a wide range of things in there. So it's going to really smooth things out over a long period of time. And that's what we're trying to take a look at. I want to also add one thing I forgot to mention when I was describing East West Bank Corporation. Their CEO has been there since 1993. They went public in 1999. So this vision of what the company is really the CEO's vision. And you can be able to see this throughout everything that's going on. Next slide. So here's an example. This is a little bit older one from when I first did this for MCMC back in 2019, or actually 2020, is that they're also doing some film financing, both here and in Asia, in India and in China. So they were part of Orange of the New Black. So again, this isn't like a major component of them. They're not just doing entertainment financing, but they're branching out into that along with some of this is actually considered in the industrial part of their loan portfolio. So keep that in mind. But again, these are the things that they're doing. And since they're in Pasadena, they're right in the epicenter of the entertainment industry there in LA. Next slide.
5 minutes.
Thank you. So one of the things I like to do, and I did this in core, is what I do is I just sort of look to find all the companies that are very similar in the same sector. This is in the diversified banks. And I sort of look through all of them to see which ones are better. There's no judgments on this. I did this in core. And what I'm really focusing on is the management comparisons that I've highlighted in that green box. And what you can do is over on the far right, you have the industry averages. And any company that's better than the industry average, I mark as a plus. So you can see all 5 of these companies in the diversified bank, as large as Bank of America, and one that's even smaller I'd never heard of, Bank of NT Butterfly, it's the center one. All of them have a pre-tax profit higher than the industry average. 4 of the 5 have an industry are better than the industry average on return on equity. Bank of America just barely misses. And then on debt to capital, the 2 smaller companies have the lowest amount of debt in there. So that tells me that the 2 I should be looking at, again, are Bank of NT and East West Bank Corporation. So let's go to our next slide. And what I did is sort of like what Kent did, is I'm showing you the compare peers. Now, I'm supposed to be doing this in core. The problem is that the return on average assets, if you can highlight that in the evaluate management, Cheryl, just sort of move your mouse there. Do it up on the one on top where East West Bank Corporation is. One more, higher. There we go. So the return on average assets, that shows up just in plus. And to give you an idea, return on average assets for banks is anything like above 0.75. That's about average. When you're over 1.0, show them where the return on average assets for East West Bank Corporation is. It's 1.58. If you can circle that with your mouse, please. 1.58. No, the 5-year average. That's just a single year. There we go. So that 5-year average. So anything that's above 1.25 is really, really good. And this is 1.5. So here are the 3 companies that look the most promising. And see how the only one that has all green in all 4 parts of the trends is East West Bank Corporation. So I really feel confident that this is probably the strongest one in this diversified bank. Again, it's a little different than Axios and Western Alliance, which a lot of people look at. Next slide. So here it is. A lot of people say in core you can't see the up, straight, and parallel, and the answer is yes, you can. If you go to analyze growth in this third step, you'll see the sales and the earnings and the pre-tax profit. And as you can see, we get up, straight, and parallel. This is really it. And you can see the historic sales growth and earnings growth down in the lower right. Sales, the 10-year average is 10.1%, which is great for a medium-sized company. And then the earnings for the 10-year average is 14.4. So they're both very, very good, and you can see that with the lines in there. So I feel very confident with where we are. Next slide.
2,
Thank you. And so we now, if we look at the pre-tax profit, now there aren't really good comparisons with industry averages because they're so off. So I just do with some individuals. So I'm just using the industry average as a comparison. So the light blue is the industry average, and here's their pre-tax profit, and they're clearly better than the industry average. Let's go to the next slide, and we'll see the same for return on equity. Here it is. Again, higher is better, and this is a good indication that we're getting the strongest one in this diversified bank industry. Next slide. And so this one's a little different. With debt to capital, obviously lower is better. And here you can see the industry average, and it's lower than that. So this is really, really good for them. All the management metrics are showing up to be the best. Next slide. So when we do the high and low prices, I'm looking at this graph here showing you the plotting of the high PEs on the left-hand side and the low PEs on the right-hand side. And those lines that are going through, that red line on the left, that's where I'm estimating future high PEs for this at 13.5. That's where it sort of measures. So you can sort of see it's come down, but I still think it can be able to rebound and be in that area. On the right-hand side, where I have the purple line, that's where I'm estimating my low PE of 7.0. So you can see I'm really pretty much in the good range for it. Now the thing is that with this, my low price of 62 in this was too close to the current price, so I just dropped it down to 41. That's how I came up with my high and low prices. Next slide. So with our 5-year potential, it does pay out a dividend. I set it at 20%. I think that's sort of pretty good. We get an upside downside ratio of, I think it's 3.3 to 1, 3.9 to 1. And I have this as a buy all the way up to 74, I think 74.80. And the closing price was 72.50 here. So I've been kind of cautious in everything, and I still think that this is solidly in the buy range. Next slide. So I like to look at the audit. Here's some of the things, the earnings and sales growth. Those historic things are not as good as the latest quarter. Some of that is, again, because of sort of the interest spread that's going on. So they were, that's kind of tough. One quarter being off for a company that has shown great consistency and has the same management team, I'm less worried about. If it starts to show into a trend, I'll notice that when I review it. In terms of the forecast down there, it's telling us that the value, it may be too good to be true in terms of on sales. And I believe the reason it's beaten down like this is that people are running away from it. Remember what I said about Warren Buffett. We want to be fearful when other people are greedy and be greedy when other people are fearful. I think that people are running away from this for the wrong reason. Like I said, I've owned this. I've doubled my money in 3 years. And I think I'm well positioned to be able to see even further growth as we go forward. Next slide. So it's a medium-sized steady growth company. This is not going to be one of those boom, boom growers. However, all of these metrics are better than its direct competitors. You may find, again, Axios and Western Alliance, which are more commercial, may have a little bit better banking metrics. But overall, in this area, this is the best in there. And I have it as undervalued. Its current PE is 8.2 and the 5-year average is 10.5. That's an indication of undervalued. It's if the PE is below the 5-year average. So I think this is a buy up to 74.70. That's where you get 3 to 1 and a 15% return. And I think this is a worthy candidate to put on your watch list or even purchase. That's my presentation. Thank you. And so now we're going to do 2 and plus. The first one is going to be Florentia, who's our newest and first time presenter, number 29 in the whole sequence. And then we're going to come to Gladys and she'll talk about Ares Capital Corporation. So let's go over to Florencia and take it away.
Thank you. Good evening, everyone. I am Florencia and I am with MCMC as a club member. Tonight I will present NAPCO Security Technologies. It was founded in 1969 and it went public in March 1990. I found this stock in the BI first cut. Next slide, please. Using the ticker symbol NSSC. Looking at first cut, if you go here under find great stocks and first cut, you would be able to identify this particular stock. Next slide, please. I was interested in this stock because times have changed since I was a little girl, and because it is focused on security and protection, safety and protection, I thought that this was a worthy stock to actually just look at more closely. It has a global security market in 2022 at 143 billion, and it's expected to reach 317 billion by 2032. So there's a lot of potential with this particular stock. It is large in North America in terms of the security market share at 33%. There's a lot of video surveillance where 47% of the global revenue share in 2022 and 50% of the revenue share in 2022 for the systems integration and consulting segment. Military and defense actually covered the highest revenue at 26% in 2022. Next slide, please. On December 11th, Forbes published their top 100 small cap companies. So it being a small cap company, there's a lot of potential for growth. It ranked at 70 out of 100. And then in the business services and supplies industry, it ranked of all the 100, there were only 9 in that segment, and it ranked 3 out of 9. Next slide, please. Take a look at this particular slide at the right-hand side, and you'll see all the other driving increased investment, security, and safety trends. But the growth drivers are copper phone line obsolescence, as well as school safety. So these are the growth drivers for this particular stock. Next slide, please. So NAPCO Security at a glance. The 3 brands are alarms and connectivity, locking, access control. And we find that the majority is in commercial industry, and then they are also present in residential. Next slide, please. The unique integrated platform across all security systems that we just viewed, which was alarms and connectivity, locking, accessing architectural, access control, but most importantly, and here are the key end markets that they serve: commercial and small business, schools, healthcare, pharmaceuticals, correction centers, transportation, and residential homes. So there's a wide spread of need in which they are able to serve, which means that they have recurring revenue services, as well as a lot of potential for growth. Next slide, please. With large growth in school and campus security, I decided to actually share with you the number of schools in the K-12 market. I'm actually an educator, so that's important to me, as well as the campus for universities and colleges. What kind of products do they have? It is lockdown, locking, retrofit classrooms, door access, alarms, and enterprise access security and video. So we can see that there is that potential for growth because, you know, the schools are increasing and they have to be safe. Next slide, please. And looking at the billion-dollar industry, we have commercial security, we have school security, and we have residential security. There is a lot of white space in this industry, and so therefore there's a lot of potential for innovations, hence growth, and therefore sales as well, in order to be able to continue with recurring revenue. Next slide, please. So the distribution amongst NAPCO, there are different strategic advantages, and their distribution in the US is about 350. For independent integrators, there are more than 2,000, and for independent dealers, there are more than 10,000. So looking on the right-hand side, there are a lot of partnerships. There's they have a robust product portfolio. There are it's a high-quality product, and they have a lot of reliability, as well as they are fully integrated solutions that are easy to install, as well as supporting professional growth and profitability. Next slide, please. It's attractive because there's a lot of revenue that could be recurring over time. So in 2017 up into 2023, the year-over-year growth is at 30%, up to 30% over that time frame. Next slide, please. So recent performance led by its attractive financial prospect. This was actually published, I think, on January 4th, and the return on equity is at 23%, which is 11% higher than the industry's average, which is really important to note. And they have an exceptional 22% net income growth seen over the past 5 years, as well as it is trading at a market fair value. Next slide, please. Looking at the judgments, I have here a revenue growth comparison with their competitors. And if you look here, looking at the industry average at 9.1%, we can see that NAPCO is competitive also at 9.1% and performing above their peer group average. Next slide, please. Hello? Can you hear me?
I can hear you.
Yeah, I went ahead a slide. I'm showing slide 80.
Okay, thank you.
Earnings growth comparison.
Yes, thank you. Thank you. My apologies. All right, so the earnings growth comparison, also looking at the industry average at 21.7, we can see that NAPCO is competitive and actually trending above that, as well as the peer group average at 5.4, so it's above that as well. Next slide, please. And the pre-tax profits on sales is also notable, with the industry average 3.7, whereas it's 14.5 for NAPCO, and the peer group is negative numbers, and that's way above that. Next slide, please. Risks to consider: there's a material weakness comprised in the company's credibility. So NAPCO continues to rebuild faith among shareholders. The corporate expresses a need for securities or industry analysts to publish their research and reports so that people know more about their company and how it compares to others in the same industry. There's future leverage, and wondering if it can actually maintain expansion in the future with its high profit margins. And then, is it too good to be true? Their ability to maintain the financing that they have so far, as well as their ability to sell. Next slide, please. NAPCO, since its beginning, has actually traded 8 times, and those 8 times have happened between 1982 and last year, 2022. Next slide, please.
5 minutes.
Thank you. The front side, we can see that it is up, straight, and parallel, and what we are looking for at a glance to see if this is worth looking into more deeply, and that is what we have here for this visual. Next slide, please. So when looking at the judgments that I suggested, I looked at some resources. I looked at Yahoo Finance, and it told me a sales growth from this year to next year. And I used that kind of a medium number, and I got 12. I decided to use 12, which is a little higher than the average. And then for the historical earnings per share, I utilized Seeking Alpha, and it had 16.2% in June 2025, and so I just went with 15.9. So that is where it helped me in order to make judgments. Next slide, please. And looking at the management evaluation, the management is doing very well, and you can see the trends for pre-tax profit on sales has a picture of it trending upward, and it actually trended upward until 2019, and then there was during COVID, the company was impacted, but since then they're recovering with the trend going upward. For the return on equity, we can see something very similar up until 2019. For the most part, it was increasing, and then there's that it was impacted by societal measures, as well as 2021, it increased and has been steadily on the rise for its return on equity. And finally, the debt to capital ratio, it was high. It was whittled down by 2019 and 2020. We can see it's high, but it's going in the right direction where it's whittling down again with the trend going downward. And that's what we want to see with the management of a well-performing company. Please, next slide.
2 minutes.
Thank you. The price earnings history, we can see that it is a paying out a dividend, and that's very recent in 2023. And we think that that's because it wants to encourage and inspire folks to look closely at them because of that extra income that you can actually get from it. And we can see that the current price per ratio at 39.2 as compared to the 5-year average, it's very, very close. Next slide, please. Looking at the risk judgments, we can see that it has an upside downside ratio at 4.9 to 1. And we can see that it is in the buy zone, which is really important to note. Next slide, please. In the buy zone, it is actually the closing price today was actually 33.47 cents, and we can see here it was on 1/4. It has a total return of anywhere from 15.2 up to 21.7%, which is good in terms of thinking about what you can get in return for buying this stock. Next slide, please. And in conclusion, this is a small size, high growth company with impressive profit margins. The company is reinvesting heavily into its business, which is very promising because they believe in their company. It's trading at a fair value. It is a buy with a 4.9 to 1 upside downside ratio with a total return of up to 21.7%. I think it is a worthy candidate for you to further research on your own to make your own judgment on whether you want to put this in your portfolio. Thank you.
Thank you, Florentia. And now that you've completed your presentation, we'll give you the official hand signal so that you can be part of the club now here of all the people that have done this. Anyway, last but certainly not least, Gladys, will you tell us all about Ares Capital Corporation?
Yes, good evening, everyone. Well, I'm with the Model Investment Club of Northern Virginia, and I'm talking about Ares Capital Corporation, which is in the Better Investing's January issue as its undervalued stock. As you know, we all have to cover the stock to study and the undervalued. Next slide, please. So there are two pages that I want you to look at in the BI January magazine. Page 8, the ABCs of BDCs, and that is business development companies that may provide hefty yields. And guess what? This is an absolutely new departure for better investing. This is a way for us to invest through a BDC in a private equity or venture capitalism without requiring one to be either an accredited investor or invest through crowdfunding. And page 24 begins a 3-page discussion of Ares Capital Corporation, which better investing people claim is an alternative lender which is taking business away from banks. In the lower corner, you can see its corporate offices are in Los Angeles. Next slide. From its investor relations page, here's an overview of Ares Capital, which is called ARC on the NASDAQ exchange. It's in the financial services sector. The industry is asset management and specialty finance business. And it's a business development company, as we mentioned, and that we'll talk more about that later. And it launched in 2004 and issued its first publicly traded common stock in 2010. It's small in terms of sales or revenue, less than $1 billion in 2022, but large in market capitalization, which we use many times for a bank. It was $11 billion. Its focus and objective is to serve particularly U.S. middle market companies and generate both current income and capital appreciation through debt and equity investments. And as of 2023, it makes debt investments of about $10 to $100 million per company. Now, the legal requirements, which are very different from banks, is a BDC has to invest 70% of its total assets in securities and indebtedness of private U.S. companies and certain, in other words, distressed public U.S. companies and securities. And it's also a regulated investment company, an RIC. It must meet diversification requirements and, like REITs, distribute 90% of taxable income to stockholders. Its management team is stable and experienced. Many of them I looked up and got their start 20 years ago, in the Royal Bank of Canada. Next slide. Now, what has happened to that non-bank lending is catching up to bank lending. Well, according to the Ares website, commercial banking declined in 50% since the great financial crisis, resulting in more regulations and bank consolidations. At the same time, the number of public companies also declined by 50%. But the average market cap increased 8-fold. So now fewer but larger commercial banks focus primarily on larger company borrowers, especially when credit is tight. The results have been a retrenchment in cash flow lending to small and medium-sized company, where private equity and private debt help fill the void. Next page. So this chart just shows you the decline in IPOs, publicly traded companies, in the last 10 years, and the concurrent growth in private equity investments in these companies. The dark blue show the IPOs of companies joining to become public companies, and the light blue show those companies that are staying private and turning to private equity to fund their growth. Now, the advantages of private equity to companies and investors are, they say there are no intermediaries, not all those are pesky reporting requirements, and greater flexibility. There's a partnership orientation. Frequently, Ares will take seats on the board of these companies, and offer a lot of advice. And they're, for investors, less volatile total returns of 5 to 14%. Next slide. Where did they get their money? Well, from institutional individual investors, and they co-invest with business partners. And as a result, they buy the equity shares in these distressed companies, or they launch loans so that they for these companies, and they get their money from the interest and dividends on these income-producing securities, the loans and the bonds and the equity, and that ranges from over 10% to over 12%. Now, the key metrics for ARC portfolios involves protection and equity. They have an interest rate coverage ratio to fair value, which means that if somebody can't pay back their loans, they can always tap into their stock or the equity in the company, the fair value. Next slide. When you look at the quality metrics for banks versus ARC, in the middle columns, I looked up on bankrate.com the 10 largest, most solid or most admired banks in the country, and then compared them to ARC. So if you look at the metrics on the left, loan to asset ratio, quality banks range from 60 to 80%. ARC fares pretty well, over 70%. Loan growth, quality banks 4 to 5% a year, ARC 12%. Return on average assets, quality banks, as I think Kevin mentioned earlier, they like over 1.5%. ARC is over 5%. For average return on equity, quality banks are usually about 8%. ARC is 11%. The realized loss ratio, the quality banks are less than 1%. ARC is actually 0. They've had none in the last 20 years. Average dividend yield, 10 largest banks, about 2%. ARC is almost 10%. Next slide. So looking at that, a similar slide to what Kevin presented for his bank, ARC's asset portfolio focuses on defensively positioned companies in less cyclical industries, and it's a highly diverse portfolio, 490 companies with in a lot of different sectors. So on the left circle, you can see that 70% of the asset class is debt and only 30% equity. And on the right, there are all kinds of industries, the largest of which is software and services, 23%. Next slide. Again, another look at the assets by fair value and number of companies. They grade them by into 4 quartiles, and with the grade of 4 being best, 3 is good, and 1 is distressed. And if you notice in both of these sets of bar graphs for the last 3 quarters, that 89% of their portfolio is greater than a grade 3. Next slide.
5 minutes.
Okay. So now let's take a look at the SSG. Notice, first of all, there is a dip in 20 and 22. You saw some of this perhaps in Kevin's slide. Financial industry had a downturn with sales and income in many banks because of high interest rates and inflation, and also COVID. But if you look at the top lines, the sales in the net income in orange and the sales in dark green are closely aligned and closely tracked. And then there is a green line that goes through the two that slightly tapers upward, and that is the growing dividend payout, 10%. Now, analysts' estimates say that 2 years they would think that sales will grow by 84%. Well, actually, I used 6.5% and for say 5-year sales, and 4.5% for earnings per share. Next slide. And if you look at the fundamental data, the historical total assets, as we mentioned before, has been growing by 12%. Pre-tax profit on sales is over 93%. Return on equity is a strong 11%. Debt to capital is kind of average 50% for financial institutions, and return on average assets a whopping 5.37%. Next slide. Then we compared it to peers. I found that you can read the peers yourself. These are the best that I could find, but in comparing areas to the group of peers in pink, historical sales, they're better than their peers in both historical sales and earnings per share, and comparable in debt, where the peers have about 47% debt and Ares has 51% average. Next. Choosing high and low prices for the next year, you can see that prices for this stock have gone up about $1 a year over the last 5 years, from a high in 2018 of 17 to a high in 2022 of 23. The current price, of course, is almost 20. The 5-year average PE is 10.3, and the current PE is 8.6. So to forecast a high stock price, I decided to use the average PE forecast times my EPS forecast, which gives me a high stock price of 29.2, which is just $6 higher than the highest it was in 2022 in the next 5 years. And then the selected low price, I used the 2021 low price of 16.4. Next slide. That gave me a hold and an upside downside of 2.9 to 1 right now. But if we were just made at 19.60 cents, then you'd have a 3 to 1 and a 15% total return. Next slide. So these are just some areas in bank research resources you might like to check out if you want to do your own research on this company. Next slide. In conclusion, it's a large size by market cap and small size by sales value company, because you're really buying it for the dividend. ARC is well managed, as evidenced by its good ROE, excellent ROAA, 0 investment failures, and for investors, low risk for high consistent dividends of 10%. It's trading below its average PE, but fairly priced. It's a buy up to $19.60 and could be a candidate for purchase. Thank you.
Thank you, Gladys. Well, we went through those fairly quickly. So what we're going to do is we're going to now ask all the presenters and just sort of tell us where they think this company fits on the life cycle. And so let's go to the next slide, and it may make more sense. So this life cycle comes from T. Rowe Price. He described this about 90 years ago, that a company, just like a person, goes through a big, sort of an explosive and mature, and then they stabilize and decline. So we'll go through this and ask each of our presenters why they sort of picked this location for their particular stock. So Kent, why don't you go first?
Alrighty. Well, one of the things that I noticed about Gentex, at least near as I could tell for the history I was able to dig up, is that they never really went through an explosive growth phase, and pretty much slow and steady growth has been the way Gentex has been operating over the last 20, 30, 40 years. So that's why I placed Gentex up there in the mature growth, is I just can't really see it growing much faster than it is. Certainly nothing above the 12 to 13%. So that's why I placed it up there.
Okay, thank you. And I put East West Bank Corporation right in that middle. A little bit like Kent, is that it doesn't have the big explosive growth, but it's been around for 50 years, and it's just a good, steady grower. And if you can buy it when these on these particular dips, you can generally do quite well with it. I'm really, really happy with the management, and I went through all the metrics on that. So I think that this is right in that middle, and you can still do really quite well with it. All right, Florentia, why don't you tell us why you picked that location for NAPCO?
I selected that position for NAPCO because, well, the safety, securities, and protection, the forecast is saying that there's a lot of potential. It's a $147 billion industry now, and it's set to grow by up to 317 billion, and by 2032. And so that was important. It is a well-managed company. And also they indicated that they have a lot of white space, which means that there's a platform for them to create innovations and expand, and also have better sales or continue sales, so that there's recurring revenue. And so there are a lot of positives in terms of how they can continue to grow, and they are right there in the mix at the top end of it. And so I just believe that they have a lot of potential. Thank you.
All right. And Gladys, tell us why you picked that location for ARC.
Well, ARC is not a very large, I mean, it has not been around a long time, yet from 2010 to now. So it's not, it doesn't have a long history. However, its growth has been quite amazing. Its asset growth has been 12% a year. I wouldn't know that that's explosive. And to be honest, there wasn't a lot to learn about, there wasn't much written about this non-bank type of entity. And I found as much as I could. It wasn't clear how they plan to grow or what the market is out there for these private companies that are going to ask them to put together loan packages that they would sell, or bonds, and buy equity. So it's hard for me to know what that market is for these private companies or distressed companies. Anyway, but I base that largely on its growth over the last 10 years.
Okay, thank you very much. And so now that we've done all this, we can have people vote, and then after that, we'll ask some questions. So go ahead and release the vote there. It doesn't cost anything to do this. Go ahead and sure, if you can go ahead and, are you able to get the poll up? There we go. All right, so the poll is up. All the people in the audience have an opportunity to vote to see which one they like. Again, it's really more, not so much whether you want to buy, but which one intrigues you the most that you want to take a look at. And so we have, let's see, we're almost up to 40% of you voting. Maybe we'll get a, okay, we're up over 60. Late votes here. The West Coast's finally coming in with their votes. Let's see if we got any more. We're at about 62. Let's see if we can get up over 70. Any more votes there left? Doesn't look like it's moving at all. All right, go ahead and close it, Cheryl. And there we are. It was a dead heat between East, West, and NAPCO. For a while there, early on, it looked like it was going to be Aries and NAPCO. So anyway, but glad that you did that. So we put this up in a tracking portfolio. But before we do that, Brian, are there any questions? Or if there aren't any, Brian, then you can raise your hand and we can unmute you and you can ask your questions. So do we have any questions there, Brian?
Not at this time.
Okay. Anyone who wants to raise their hands and ask any questions of our participants? I see Rob is
Oh, we've
there.
got one hand raised, yeah.
Rob, you're now you're muted on your side, so go ahead and unmute yourself. Robert, you should be able. You're self-muted, so you have to hit the microphone icon.
Mr. Greenstein.
Yep, it's been quite a bit of a help for us, and he'll be presenting next month. Another first-time presenter. Anyone else? Any other questions or any other hands raised? Do you see them, Kent or Brian?
No.
No.
Well, we'll get one more shot. There you are,
Yeah.
Rob. There you go.
Finally. Okay. Yeah, for banking business, the Aries presentation, I'm interested trying to figure out why there's debt to capital at 50% for that, but their business is to place loans, provide loans to small companies. So it seems like it doesn't match up.
Okay, my understanding, and anyone else can say it in here too, is that they have to have money in order to operate, to buy up these loans and to provide them to the company. So they're getting debt to loan to these companies, is what I understand.
Okay, so they borrow from who?
Well, from investors or maybe partners, and I don't know who else.
Okay, so if it's that's just getting into private equity, which I'm not familiar with. So okay, they borrow from private equity not companies, but
Investors, yes.
yeah.
Right. And I think you asked a very good question. I don't know. It's very, for me, it was very difficult to analyze because their statements that they file with the SEC are very different from those you get from banks or anyone
Right.
else. They list all of their investments by name. So 460 names of the companies they're investing in. And, you know, trying to track through that or aggregate it is very challenging.
Okay.
Yeah,
Thank you.
one of the things I was looking at on this is that I usually use as my fallback a lot of times Investopedia, and I'll put in things like a BDC to see what they're going on. And I think one of the concerns that you know Gladys sort of touched on is that these can be you know the yields and the dividend on them are really quite good, but the thing is they're very dependent or very sensitive to interest rate spikes. So they've really got to watch things there carefully. So in that sense, it can be a little bit trickier than our traditional companies to look at. But it's clearly an intriguing one to take a look at. So I'm glad you did that,
Right.
Gladys. Thank you.
I just wanted to mention one other thing to piggyback on what you just said. On my listing of references, I did list Investopedia where I looked also.
Mm-hmm.
But they wouldn't have answered the question we were just given. So
That's true. That's true. It requires some more digging. And if there's someone who I believe will do it, it will be Rob. Rob's a good digger. Anyway, any other hands raised or any other questions? Brian, Kent?
Not at this time.
All right, let's keep going then. So if you have any other questions, here's how you can be able to reach people from the Maryland chapter, like Brian, or the DC chapter, which Gladys and Cheryl and I are all a part of, or you can reach out us to digging into the BI. There's a picture of many of us that, in fact, 4 of us are right there in the middle, are here helping out today. This was us at Banc in 2022 in Dallas, and you know, we're going to hopefully all meet up in Chicago this spring. So please come and see us, but also reach out to us at any of these emails if you have any questions or comments. Next slide. So you can also join our mailing list to be able to get stuff out. You don't have to be a member of the DC chapter, but Carol does a great job of getting out our Innerspire messages, so we appreciate that. But please stay in touch, and you don't have to be a member of either the DC chapter or even be a BI member to receive these notices. We won't bombard you either. Next slide. Kent, this is all you.
Oops. Okay, so everybody that you heard tonight is a volunteer, and as a volunteer, we learn all kinds of new things, including how to use a microphone on GoToMeeting or GoToWebinar, and as part of that learning and improving our investing skills, we get to help other folks, which is really a rewarding experience. Part of that reward also is that you can attend as a chapter volunteer better investing national training programs and events at a discounted rate. You also get some good subscription information from the Better Investing website. So just so you know, just to recap, Maryland and the DC chapters, as well as all of Better Investing, really is run by volunteers, and these folks are the what keeps Better Investing operating and in a productive way. And so we encourage folks, if you're interested, to get in touch with us and help us out. Thanks. Next slide.
Thank you. So here's what we have coming up for next month. We're going to be looking at the stock to study, RTX, that used to be Raytheon. We're also going to look at Kraft Heinz. We have a new one. This is Turomount Industries, if I'm saying that correctly. And for those people that don't know, if you see a ticker symbol like it is in the parentheses with a .to, it means it trades on the Toronto Exchange. And we have one more. I don't think we're quite ready to announce it, but it should be coming out here really, really shortly. But we're going to be here on the first Monday on the 5th. So come and take a look at us. And let's go to our next slide. I think this may be it. Here's stuff with the dashboards. I sort of organize it by every year, so it doesn't become overwhelming to figure it out. And you can sort of see how we perform on each one of these. Everything starts out with a fake $100, and you can sort of see how it's done since it was initially presented. And let's go to our next slide, and we'll show you, there's hyperlinks to all of them. Again, if you download this, download these slides, you can go to those and it'll take you directly to those locations. You don't have to have a manifest subscription. That's a separate operation than what goes on in Better Investing. But for many of us that do have a subscription there's the public dashboards and you can find them there. So one last look. Any other questions or hand raised, or are we really, everyone pretty quiet over there?
All quiet on Eastern Front.
Well, I think it's the Southern Front for you being in Southern Maryland.
Very well.
Anyway, so this recording will be up on YouTube, hopefully later on tonight, but thanks for visiting. Thanks for being here, and join us next month when we dig into the BI again. Good night, all.
Good night, everyone. And hopefully you had a chance to get the handouts and put them on your own computer or whatever you're viewing us by. But here they are again, all the SSGs for the 4 companies that we looked at, as well as the entire slide deck in a PDF file. So I'll give you another 30 seconds to hopefully be able to finish that download if you didn't already.
I think you can go ahead and do it. I think we're pretty much done then.
We will, yeah, I think so. But anyway, good evening, everybody, and good evening to our presenters and our helpers. Thank you so much.
Absolutely.
Good night.